Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right. Welcome, Andy. Welcome to the Pilot Money Guys. Thanks for joining today, man. I appreciate you being on with me.
Always. Right. Yeah. Happy to always pull down the numbers.
Nice. It's going to be an exciting one today, huh?
Yeah.
We got some
I'm looking forward to it.
Hard-hitting tax numbers. So those of you that love tax numbers, potential saving strategies, hang on tight. We're going to go fast, and it's going to be exciting. Maybe if we can make it exciting. If we can put lipstick on this pig, it might be exciting.
That's right. Yeah. We'll do our best.
Those of you that don't care about potential tax savings, future taxes, and any tax law changes for 25, maybe this is when you skip. But anyway, But before you do skip, give us a rating. Go on there, give us a rating, 5-star rating on wherever you listen to, iTunes, wherever you listen to podcasts, so that other people can hear it. So we appreciate that. It didn't have to be 5. If you don't think we're 5-star, then don't do it, right?
Yeah. And honest feedback.
Honest
feedback.
All right, we can take it. But anyway, so Andy, let's jump in. First thing, before we get into the tax stuff, in big picture today, we're going to look to the future and go, how do our airline pilots, professional pilots, corporate pilots, how do they save taxes in the future? Because sometimes right now it's really hard to find those deductions, or more deductions, I should say, on your W-2 income. So we're going to look to the future on that. Then we are going to share some ideas for saving current taxes in case you're not taking advantage of those. And then we're going to have you finish this off by talking about some interesting tax changes. I say interesting. I think they're really good tax changes for 25, especially if you're 60 or older. So hang tight. So anyway, but first, before we go on, we got some airline news. And we don't do this every time because sometimes there is no airline news. But we've been paying close attention to Spirit Airlines, and we know some people there. We love Spirit Airlines. We love their people, and they've been stressed out lately. So what's the latest? I think Wall Street Journal came out with an article today. Yeah,
it was either today or last night. But so Spirit and Frontier are in merger talks, which is kind of interesting, right, Charlie? Because this was a kind of an airline brouhaha with JetBlue a few months ago, where essentially that merger got shut down, and then of course Spirit basically then had to go into bankruptcy, which is kind of interesting if you just think about kind of how that process works. So it sounds like, obviously still speculative. At least, they're to the point where they got a Wall Street Journal article about what could happen here. But it sounds like, Spirit still may have to go through a bankruptcy type proceeding. And of course, you got to satisfy your creditors, right? Your bondholders, and out of that restructuring, Frontier may ultimately end up purchasing the net assets remaining. So that'll be interesting to watch over the next several months. So to be clear, they're not in bankruptcy right now. There's been talks.
Correct.
We've seen articles,
but like you said, they may have to go that route, I guess.
They might be closed. It sounds like from what I'm reading, they drew down their last line of credit, and they're talking to current bondholders about how to restructure that debt. So they're not there yet. They might be close.
Yeah, that's a tough one. Well, hopefully it works out for those folks there. It's kind of a shame. You and I talked about, everybody feels the same way. It's like, somebody somewhere made a decision at the Federal Trade Commission that they shouldn't, merge or join forces with JetBlue, and now you got looking at a bankrupt company potentially. So unfortunate.
Yep, no doubt.
Doesn't make a lot of sense at this point, for sure. Excellent, Andy. Thanks for that, man. A lot of people, our Southwest folks, are concerned a little bit about the Elliott Group and the activist investor there. There's a lot of uncertainty going on there. They're holding, meetings now. They're a 10% share owner or better, I believe. So they have the power to call meetings. I think hopefully I'm saying this right. And then if I think I was told the other day, there's a 7 or 8 very, very large organizations that own the majority of Southwest stock. Yeah. So if Elliott has the power, I think the rules allow them to call a meeting. If they all vote together, they can replace board members, and then subsequently board members would probably replace the CEO, Bob Jordan. Did I get all that right, Andy?
I think that's right. Yeah. I mean, if you think about, this is kind of like, index investing, right? Well, Vanguard, iShares, BlackRock, I guess it's, they own a lot of shares of lots of assets because that's the index. And so that's who, when Charlie talks to you, I think you're referencing, if they can get some of those folks on board for a proxy fight, then they would definitely get the required number of votes to start changing board members out. Yeah.
Now, my thoughts are that you can change board members. Board members could change leadership, but they're not going to have the ability to go make tactical decisions like shrink Atlanta, grow Atlanta. That's going to be up to those leadership people at that time that get put in place. Now, clearly, Elliott wants to put certain people in there that have certain experiences, but so I think there's a lot of misunderstanding there sometimes on how much control they actually have. One of the things, though, Andy, that I think I wanted to bring this up today is because I'm a fan of a guy and his organization. His name's Patrick Lencioni. He's written a lot of books about organizational health. Their consulting group now out of Nashville. Andy, they moved from California to Nashville. Saying you need to follow suit.
Yeah, no doubt.
It's called the Table Group. I love their podcast. They've got a couple of them. One's called At the Table, but they are fans of Southwest Airlines. And what I mean by that is they've worked with Southwest Airlines before from the inside, consulting and whatnot on their organizational health. Now, they're not involved in any of this decision making, but there is a podcast called The Heart of an Organization. It was on September 11th of this year. We'll put that in the show notes, or you can just, go search that out. It's At the Table, Patrick Lencioni, The Heart of an Organization. So they talk about this scenario where Elliott comes in and they talk about the dangers and the risks. They also talk about the risk of changing seating policies, bags fly free, all these policies. What are the risks? Their biggest concern with an Elliott coming in is not so much the tactical like some of our pilots are concerned with, but it's more of, well, as the title alludes, the heart of an organization. And that's what they're all about, organizational health. And they believe that's what drives the success of an organization. So they're most concerned about an Elliott group coming in, replacing leadership, and then gutting the culture. That's really their concern in a nutshell. So, I don't know. As I listened to that, Andy, I was kind of like, I don't know that Pat has been involved in Southwest lately. I don't know that, that's the biggest concern for people, for our pilots. That's not their concern, is that Elliott comes in and guts the culture. That's kind of, quite frankly, been underway for a while, unfortunately, just other events. So that was their point. But check it out. They've got some interesting things to say about it and their opinions on it. And so take it for what it's worth. It's just kind of from a consulting company that's been on the inside before at Southwest Airlines. And so I thought it was interesting for that perspective.
Yeah, I guess that's an insidious risk of changing a culture to the point where it impacts performance. It's easy to look and see, they're reducing, flights in and out of Atlanta, but that's from a cultural perspective, then that's just super challenging to quantify and kind of see happen in real time.
Yeah, absolutely. And that is true. An outside entity comes in, guts a group of leadership. They don't care about culture. They don't know anything about it. So if that's, that, I think to me, that is one legitimate thing. If in fact, it's not already too late for that.
Yeah.
So anyway, that's a whole nother discussion, but it was an interesting perspective. So I just wanted to share that. We'll put that in the show notes. But Andy, what else? Airline exciting news.
I think we covered it. Yeah. Okay. I think we covered the exciting airline news.
That's the head of the section, right? Exciting airline news.
Exciting airline news.
Now we're going to jump into exciting tax news.
Keep it coming.
Yeah, keep it coming. So we're going to talk first again about future tax savings. A lot of our people say, hey, look, I was talking to somebody today. We've got to hurry because we have a month and a half or so left. No, actually two and a half months by the time we're recording, but we don't have much time. We got to do some things by the end of the year. I was like, well, there's not a whole lot more you can do as a W-2 employee if you're doing some certain things, but there's a lot of things we can do to prepare ourselves for tax efficient income in the future. So Andy, I'll just throw a couple of things out here, but you can pile on. I mean, we're big fans of the Roth in that regard. We're not fans of Roth at any cost, but we are fans of Roth to help with that future tax efficient income at retirement.
Yes. I think, I was thinking about like, where are you going to get your Roth? I think, and we'll get deeper into this, is, the idea of making backdoor Roth contributions, right? So that's just how you can get that 7,000 or 1,000 if you're at age 50, an additional 1,000 if you're an age 50 up catch up. But, can we get some Roth exposure that way? That's kind of like free Roth, in my opinion, right? So, to your point, Charlie, of, hey, we don't want Roth at any cost. And you're talking about Roth conversions where we're paying at our marginal tax rate today to convert assets to a Roth in the hopes, or I guess not in the hopes, but they understand that we won't pay taxes on those assets in the future. Well, from our backdoor Roth, which is just an after-tax contribution into an IRA that is subsequently converted into a Roth IRA, it's like you're already paying taxes on it. So let's just sock it in the Roth. So that's the free Roth. Mm-hmm. And then, to me, that's kind of like, no matter what your tax rate is, that makes sense. And then to your point, Charlie, it's like, how strategic do we want to be beyond that point? I know we did a podcast on Tax Cuts and Job Act expiration at the end of 2025, right? And so that's going to change those numbers pretty dramatically.
Yeah. We did another podcast on to Roth or not to Roth.
Yeah.
Clever name, maybe, but nonetheless, hopefully that was useful to refer to. But one of the things that you mentioned there, I want to stress, and there are some folks out there that think, hey, I make more than X amount of income, so I cannot contribute to an IRA at all.
Yeah.
So I think that's the biggest myth I'd like to dispel right away, is anyone with any income can always contribute, like you said, to an after-tax IRA, non-deductible IRA, whatever the heck we want to call it.
Yep. Yeah. Yep. Exactly right. And then for those who are making less than 230,000, this is 2024 filing joint modified adjusted gross income, you can make a direct contribution to your Roth IRA. So the point is, for some of our pilot listeners who are kind of younger FOs, I also don't want to steer you into the path that you have to do the backdoor Roth. You may frankly still be in the window of just making direct contributions into the Roth IRA, and then frankly that's just one less level of complexity from a planning perspective. But you could be, to Charlie's point, is it kind of doesn't matter. There are some unique stipulations when we start talking backdoor Roth, but everybody should be able to get after tax contributions at a minimum into an IRA.
Yeah, absolutely. So we're not going to get into the weeds too much on the backdoor Roth. There's some complexities there. One of the things we want to highlight, those, is if you have a large pre-tax IRA, let's say you rolled over a previous 401k, a backdoor Roth, you're going to pay tax on that conversion if you have another pre-tax IRA out there somewhere. It's called the aggregation rule. But one of the things that we like to do is, you called it, I believe, a reverse rollover. So take that IRA, that pre-tax IRA, roll it back into your current 401k.
Yeah.
And now you're cleared and hot to do the Roth, backdoor Roth, I should say.
Yep. Exactly right. Yeah. The stipulation is your plan has to allow for it. And so they've got the plan, summary plan description. Obviously, you just call you call the plan provider for your particular airline or company, and they'll tell you what's possible. But that is a good way to, effectively what you want is to zero out that balance, as Charlie noted, from a Roth IRA or a backdoor Roth consideration.
Yeah. Before we move off of the Roth stuff, because we love it so much, what are there's a couple other scenarios. What come to your mind as far as when are good times to think Roth?
Yeah. So now it's like we talked about the free Roth is it's, kind of a misnomer, but the backdoor free Roth is kind of everybody is a player. Now Roth conversions, right? Now it's like, now we got to think about, does it make sense, right? And so, frankly, the math is kind of straightforward. It's if you expect your tax rate to be lower today than it would be when you're withdrawing from your IRA or 401k, then a Roth conversion makes sense. If you do the math, and if you had a Roth conversion at 24% and you withdraw at 24% of an IRA in retirement, you have the same amount of after-tax money, right? There's no difference when you do that. So you're thinking about now, what are tax rates in the future, right? What are those going to look like? We know what the tax rates are today. We know what they're potentially going to be if the Tax Cuts and Jobs Act sunsets in a year. But we don't know, right? If you're in your 30s, we don't know tax rates 30 years from now, and so we have to make somewhat of an assumption and kind of in what those, how much you're going to need to withdraw, and again, we don't know what those tax rates are going to be. I like to use 1987 as a good kind of reference year. It was a really good year. I happened to be born in that year. If you made, these are in 1987 dollars. If you made over $90,000, you were in the 38.5% marginal tax bracket. Wow. At a 3% inflation, that's about 268 in today's dollars. If you just take a straight line 3%. Wow. So, like that, that wouldn't be inconceivable to be in some of those tax rates, even in retirement, if you have large after-tax assets, after pre-tax assets that you have to withdraw from.
Wow. Good job.
I think, Charlie.
That was amazing.
That's all in my head. I didn't, yeah.
So, just to put an example to this, we see a lot of, sometimes people come out of the military, for example, retired military, early 40s, brand new at the airlines, and they've got some other savings. Maybe there's some pre-tax savings that they have. I think those are good times potentially to start do some conversions. And that applies to brand new FOs as well, except some of the brand new FOs now are 23 and 24 years old, and they don't have a whole lot of other, assets to convert. But I think, probably a retired military person or a person that's been in the military 10 plus years or so, and they're a brand new FO, I tell them it's a good chance you'll always make more money than you're making right now.
Yeah.
And so that's kind of a scenario where maybe I should get as much Roth as I can for a while, maybe even do some conversions.
Right. Right.
I think the other scenario that is one we've seen is where you have older parents and you're going to inherit some money. It's kind of hard to think about these things sometimes, but they should convert to Roth if they're in a reasonably low tax bracket. And it's just a math issue at that point. Sometimes a lot of our clients are in this 32%, 35, 37% tax bracket. Their parents are in a 12, 22. And so it's just a mathematical difference there to have that conversion done so that when assets are inherited, they're inherited at a lower, at zero tax instead of at humongous tax rate.
Yeah. And we certainly don't want to go too deep down that path, but the laws have changed substantially on inheriting IRAs. And so if you inherit as a 60-year-old captain, you're gonna lose a lot of that inheritance just to the taxes being paid.
There you go. That's a good way to put it. We don't want to lose money to the government unnecessarily, and that's a planning aspect that people need to think about if they have older parents that they're pretty sure they're going to inherit from. So, Andy, the last one that I'll say there on the Roth conversion stuff before we move on is the newly retired airline people, professional pilots, newly retired, usually have an opportunity for at least a few years, maybe more, to do Roth conversions to pay tax at a lower rate because RMDs are going to kick in later on. Social Security income is going to come on. And so that's an opportunity we see as well for some tax savings.
Yeah. Yeah. And that would be, you're in the 37 today. It's like, let's not do that. Right. If you're 55 let's not convert at 37, but we know we're going to be in a lower, just like you said. And so you kind of make the pre-tax now, let it grow tax deferred, convert it in a lower tax bracket.
Yep. All right. I love it. So those are some future tax savings, really all about the Roth, but when and how to do that. And each one of those topics, Andy, could be its own podcast. So
no doubt,
make sure that you do your due diligence. That's not tax advice, because each one of those are complex. Everybody's different. So let's move on to some current tax savings ideas before the end of the year. And the first one I'll throw out there is, because I want to say it is kind of fun, is just to donate stuff. And by that, Andy, I mean, we've talked to a couple of people lately. They're like, I'm cleaning out my house. I'm downsizing. The kids have gone off to college. Yeah. We have a lot of stuff. And really, we don't want to have a yard sale. I don't want to have a yard sale. You could do Facebook Marketplace, and you sell you sell the $5 item, and somebody comes to your house and they're a mass murderer. It's not worth it.
For sure. Yeah. You're doing some weird meetups in the Walmart parking lot.
Not worth it. I'll take a tax deduction. So anyway, we talked to a couple of people lately, and now you got to do your paperwork on this. This is not if you're going to donate more than $250 of clothes or household items, you got to have documentation. And you've got to have, I think Goodwill is going to give you a list of what they're worth, I believe. So anything to add to that, Andy?
No, I need to start getting the every time I go to the Goodwill, they're like, do you want a receipt? And I'm like, nah, I'm good. Yeah. I need to start doing that.
That's right. I think these are even a form. So you and I looked this up on the IRS website. The best part about the IRS website, it's on the givings. It says, number one, if your goal is a legitimate tax deduction.
Yeah.
So there we stopped and we turned it off at that point. We're not interested in that. But anyway, so we go down here to number 7. It says cash or property equaling $250 or more. You must have a bank record, payroll deduction records, or written acknowledgement from the qualified organization showing the amount of the cash and the description of any property contributed. Now, we'll be honest. I mean, this is a red flag. If you go and donate $50,000 worth of stuff from your house, then it's a red flag. But you can also do this legitimately if you keep good records, do the right paperwork. Again, it's legit. As the IRS website says, if your goal is a legitimate tax deduction, here you go, do it right. It can be done, I guess, Andy, is what I'm saying.
Yeah. Yeah. Just, be prepared, like you said, for, maybe some questions to be asked. And then if everything's above board, then of course it doesn't matter.
Absolutely. So, all right, what else you got on this current tax savings?
Yeah, I'd just say you don't have to just donate stuff, right? You can donate cash or appreciated securities. If you have a taxable account, brokerage account, and you're looking for, let's say you're charitably inclined already and you give maybe smaller amounts annually. Well, if this was a good year, we had some folks get a bonus and you want to just front load that giving, and you've got some, that's good in and of itself, because now you got to have above the itemized deduction limit to take advantage of that. And then the cherry on top of the ice cream cone, I guess, is, it's like if you got highly appreciated securities that you would otherwise pay large embedded capital gains on, you can give those. I mean, they're long term. So that's another option if you're just looking for, hey, this year by 12/31, I want to do some giving. We've got a lot of opportunity there. Mm-hmm. That's something definitely to look at.
All right. And there's a cherry on top of the cherry on top of the ice cream cone. A lot of research says that the only way your money is really going to make you happy is if you give it away. So, just saying. That's some legit research out there.
Yeah.
All right.
Sounds legit.
It is, absolutely. So you talked about the giving of appreciated stock. Donor advised fund can be used. Doesn't have to be.
Yeah.
But a lot of times people don't know what they want to give to. Maybe there's multiple organizations. And for example, a case study is we've had one of our pilots retire. He also subsequently got a bonus, and it was actually his highest income earning year ever. So he chose to make almost all of his lifetime donations in 1 year. Yeah. And so he doesn't know exactly who he's going to donate to. So he's got a donor advised fund. You could donate a significant amount into that, take the tax deduction in 1 year. There are some limitations, but it's a pretty massive tax deduction. And it was a perfect scenario. He's charitably inclined anyway. Obviously, you got to want to give away money for that to work, but it turned out to be an amazing strategy.
Yeah. 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 It's the benefit of that donor advised fund is, you could 20 years down the road, you can let that thing grow like an investment account and give away those assets.
Yep. Yep. Phenomenal. All right. Awesome. Let's see. The health savings account. I'm a big fan. Now, you cannot go and pick a healthcare plan based off of a tax deduction advantage. It's got to be based off of some healthcare, priorities, right? Do you have ongoing health issues? Are you relatively healthy? All that kind of good stuff. So if the health savings plan or a high deductible plan fits you, a health savings plan, a health savings account that comes with that plan, you can contribute. The 2025 contribution is $8,550 for a family.
Yep.
If you're 55 or over, it's a $1,000 catch up, which puts you at $9,550.
It's good math.
And then I think if you're single, $4,300 a year, right?
That's it.
Any thoughts?
No, I think you're right. It's don't make a healthcare decision. Make a health plan decision based on the healthcare needs that you have, right? And then this is if I think when I think about HSA and high deductible health plan, which is the health plan you need to be in to be eligible for an HSA, is if you're otherwise fairly healthy, those have lower premiums typically, but they have higher max out of pocket, higher deductibles. So if you're otherwise a fairly healthy person, now what does that mean? We don't know because. I don't know what my health's going to be tomorrow.
Exactly.
So you're kind of making a bet here, but I love the HSA. And then I think the next step on the HSA is, man, what if you could contribute that maximum amount every year and not withdraw, right? To pay for those existing year, but treat it like another stool or leg of the retirement planning stool, if you will, because those healthcare costs are going to be huge in retirement. The math on that is hundreds of thousands of dollars for those, with Medicare over 65. And so to have an HSA that has had some substantial growth now that you can use as part of your, retirement planning with triple tax benefits, I think is a great option. So I think people kind of overlook that as even just a retirement planning type consideration.
Yeah. I think a lot of times people get confused with the health savings account, HSA, versus the flexible savings account.
Yeah.
Flexible savings account is use or lose. The health savings account, that's your money. It's like a healthcare 401k.
Yep.
I do exactly what you said, Andy. I don't pull money out of it unless it's a significant amount. And that's the definition of significant amount changes. Last year it was Christmas season. I was like, shoot, an amount that was not significant before became significant. And I used the health savings account. No big deal. Yeah. But a lot of times I just don't use it at all. I let that money, it's invested. It grows tax-free, like you said. So again, I think that's a good example though of all these tax strategies. I'll quote Kevin Gormley and whoever else said it before him, but don't let the tax tail wag the dog. You can't make decisions based off of taxes first. A lot of other things going on there.
Yeah.
So what else you got? Current tax savings.
Yeah, no, I think we're almost, I'm thinking more, hey, now we're looking at 2025 a little bit here, right? As we're in open enrollment season, you're picking medical plans. What if you weren't already in that high deductible health plan, you switched into that and now became eligible for the HSA. So there's some future planning opportunities to think about. And I think, the things I want to know as I round the corner into a new year is obviously we just talk about healthcare plans, life insurance, have the right amount. And then, hey, now I got to, start putting money into the 401k if I haven't, if I've already maxed that out for this year, and just thinking about, what is that right percentage? And that gets fairly complex, especially for most of our airline folks, and just based on the contract and some of those non-elective contributions of how to plan for that. But what do you think, Charlie?
Yeah, it does get confusing, especially, like what should I do? First of all, Roth and non-Roth. But we, I want you to, if you can you walk us through the changes in 25 to the catch up, right? Because that's kind of a big deal.
Yeah.
And I know there's been a lot of confusion out there with, I think in 26, if the companies are on board, if the IRS sticks to their schedule, all catch up contributions will be Roth in 2026.
Yes.
And these have been in the works for a while. But in 2025, the catch-up contribution changes significantly for those in their early 60s. Can you explain that to us?
Yeah. Yeah. So this is new. So it's for those who are going to be not older than 63 by the end of the calendar year. So 60, 61, 62, 63 at the end of 2025, you can make an additional, I shouldn't say additional catch up, but a catch up beyond the traditional, right? So used to be if you were age 50 plus, you could put 7,500 catch up. That still exists for those who are age 50 and up. But for that weird 60 to 60, and I only say weird, like tell me this isn't a government operation that just, like Charlie and I were like, what? Who made this?
Yeah.
Who made these numbers? But if you're in that 60 to 63, you can put, it's 150% of the normal catch up. So plan for 2025 around 11,250 of catch-up contributions that you can make for that very specific period. So if you find yourself in that window, that's more savings opportunity. Of course, that goes into like, well, how much are you going to contribute, right? Because only you as the pilot, or if for anyone who's in that age can make catch-up contributions.
Yeah. It's what you mean by that is the employer cannot make the catch-up contribution. Is that kind of what you're alluding to there?
Exactly.
And you throw the ages out. It's interesting because you could be 59 in January of 2025, but as long as you turn 60 by the end of the year, this applies to you, right? Did I get that?
Yeah. Yeah. I guess you have to be 59 in December.
Okay.
Turn 59 in December of 2024, and then you turn 60 in December of 2025, and now you are you would be eligible.
Yeah.
But I guess unfortunately, if you turn 63 this December, then you're out. You would be 60. Yeah, you're out. Sorry.
So that's a little weird. That's a good point.
It is weird.
But 150% of the current catch up, we don't know. The IRS has not put out the limits yet.
That's right.
on 2025. They probably will tomorrow, knowing our look, Andy.
For sure.
The day after we record this. But as of now, the catch-up contribution is 7,500. But those people, like you said, will have 150% more, 11,250 on the current math. So that's kind of nice. Put more money in your 401k, So
That's it.
Absolutely.
Yeah. I think the other thing to think about for 401k contributions, especially for our high earners, is, if you make over, you can put $23,000 in if you're under age 50. And so if you make over, 300,000, you're like, well, I'll just put, I'll put 10% in, right? And I'm definitely going to be good. It's like, you might not, right? And so you've got to think about that non-elective contribution interaction with your contributions and then what it is that you're trying to do, whether that's Roth or no Roth. And what we're getting at is, there's a scenario where you may kind of box yourself out if you don't contribute enough, right? So you kind of have to think about what's the company putting in, how much the company is putting in, and it becomes a little bit of a complex math problem as you think about that.
Yeah.
Any rule of thumb on that, Charlie?
Yeah, I think there's been some math and spreadsheets from some really smart people, and I think 12% is a good number and by boxing out, like we saw this year where you look at someone that's reached the 76,500 or the 69,000 for those under 50, you can see that their contribution did not make it all in, even though they got to 69,000. They're not all of their 23,000 made it in. And that's because maybe that's okay. If you're doing all pre-tax, that's okay. But if you're doing all Roth, it's not okay. And that's something to think about there as far as that's concerned.
Or if your, we'll call spill, right, doesn't come back as taxable, if it goes into a market-based cash balance plan, or it goes into
Yes.
a retiree health account or health reimbursement account for our United folks, right? Like now you're really trying to make another planning decision on
Yeah.
how you want to fund that account.
Absolutely. And we know we're raising more questions here than we're answering maybe, but we also just wanted to get the numbers and the knowledge out there, the awareness, and we can reattack these other topics and other podcasts, because it is difficult. Like, what if I'm a high earner captain and I just want to put half of my 401k in Roth? Let's say half of, 30,500. What should my contribution be? Well, we don't know. That's going to take some planning, and that's going to take some, just thinking about how much you might make, what's your typical salary. So we can't answer all those questions right here, right now. I know we're just trying to get the word out on the changes. But yeah, so big changes coming next year, big changes coming in 26, with a potential catch up being Roth, all Roth required. There's also a potential of the company's contribution being Roth in the future.
Yeah.
But you'll pay tax on that, of course. That's not a free lunch. That'd be nice. And so there's a lot of changes. And of course, the sunset provisions, the tax brackets might go up in 2026 significantly. Me and the professor, Kevin Gormley, just did a podcast on that. So we'll see how that goes. Yeah. We don't know for sure. Lots of changes. Give us a call. Andrew at leadingedgeplanning.com, Charlie, Charlie at leadingedgeplanning.com. Our office number is 865-240-2292. Give us a shout, give us an email, and we will try to maybe get on the quick call with you. If you've got some questions we can help with, we're happy to do that. So, Andy, anything else in closing before we end this exciting tax podcast?
Yeah. I just think about what your end of year requirements are. So if you're trying to do donations, if you're trying to do Roth conversions, if you're trying to do backdoor Roth and you need to do those in reverse rollover, those are 12/31 deadlines. And then backdoor Roth, those become later in the year. And then just, I just think about that 2025 planning. If you health plan, what are those deferral rates you want to take, Roth versus non-Roth? So those are just kind of like good housekeeping items. I think about as we round the corner. Hard to believe we're ending 2024, but as we shoot into 25.
I'm kidding, man. Awesome. Well, Andy, thanks so much for helping me out today and being my co-host.
Got it.
Pilot Money guys. Thanks. We'll see y'all next time.
Take care.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.